What's up? We are live and here we are. So, thanks for joining. We're going to talk about a few things today, and I want to make sure that we answer any questions we've got. I know there's been a lot of questions recently as about how to win in this market. I know there's a lot of frustration, a lot of uncertainty, a lot of just confusion. Like, what is the next step? What's going to happen if I need to buy a house now? What is the best way to do that? What's the best way to make sure I'm getting a great deal? And so we're going to talk about those things here today. So any questions you have, drop them and I'll answer those. We've got some already, but I'm going to get started. I want to show you guys a few things. First thing I want to let you guys know, I want to start about really what to expect in the housing market as we come up with 2020 and 23. Okay, so, or 2023 and 2024. Now, one of the big things I want you guys to know is that housing, I'm going to share my screen with you. Let's see here. And what I want you to know is that housing really stays strong during the recession. You know, during the during the recessions of the past 60 years, which I'm going to show you here in just a second. And I'm going to want to show you how, you know, over the last 60 years, we've had 9 recessions. And after every recession, prices have actually increased. So, except during 2008, when the crash happened that caused the recession, and not vice versa. So, I think a lot of people think that. Are we unable to get the screen share? I mean, things are different now, guys. What you need to know is credit was easily available back then. I mean, you had people that were fogging up a mirror basically and were getting loans below 600 credit scores, and you know, had a lot of speculation in the market, and you know, loans were easy to get. You know, the biggest factor is probably the oversupply of homes and not enough demand to sop up the supply. So this caused people to walk away from homes that they couldn't afford when the rates adjusted. Now the average American, you know, has a massive amount of equity in their home. Back then, you know, in '08, you had really not much equity. You had people that were buying a home with very little down or zero down. Then the rate adjusted because they were sold these products that had these massive adjustable rates. And then all of a sudden, you have people just walking away from homes, foreclosing. Well, they had no money to walk away from, no equity. Well, now the average American has anywhere from $180,000 to $300,000 in equity, and no one is walking away from that. Now there's actually a lack of homes. So, you know, the other big thing that I want you guys to know is that there was this huge drop off of people turning 33, and there's a massive amount of people turning the prime age at which people buy homes. So if you go back to 1990, people turning age 33 today, it is the highest in history. So this is huge because what this means is you have so many people on the sidelines that are waiting to buy a home, who can buy a home, who really are going to buy a home no matter what the rates are, some of these people. And so there's this massive pent up amount of demand by millennials right now at age 33 to 36, and they're going to buy homes. So what does this mean? I don't have a crystal ball, but I mean, we can look at stats and tell, hey, what is likely to happen? And that's what we should be looking at. What's likely to happen? That's what smart investors do, not look at what they're afraid is going to happen. And with the birth rate way up in 1990, you know, some of the highest levels we've seen, this is going to really provide stability for the housing market. The other big thing back in '08 was that vacancy rates were at all-time highs, and today they're at record lows. And you know, you really just don't have people walking away from the massive amount of equity they have in their home. The other big thing is inventory. So that's probably the biggest thing. Obviously, we know this is we have actually a quarter of the inventory, 25% of the inventory that we have today that we had back in 2008. We had 4 million homes on the market for sale in 2008. Today we have a million. And after you take out the homes that are actually under contract, which is about 400 some odd thousand, you're left with 600,000 homes in a country full of 350 million people that people are fighting over. So, the problem is that people think that housing is going to go down, but we have to look at supply and demand. Um, Housing bubbles do occur. Housing bubble in '08, like we talked about, was really because you had a lot of things going on that we just don't have today. You had massive speculation, you had rampant loans that were being written, and you had a lot of foreclosures going on, and there was just a massive glut of inventory, and people weren't buying the homes. There was just wasn't enough demand to sop up the inventory. That's going to bring prices down. But when you have little inventory and a massive amount of people trying to buy and are still slated to buy over the next several years, then that's going to really elevate the prices. I mean, sellers are not likely to drop their price when they know that they can get more for the house because there's more demand. And think about this, since 1941, housing's record of, of pluses and minuses is actually 73, 7, and 1. Can we get it over here? 73, 7, and 1 over the last 80 years. And nationwide in 2000, go ahead. Sorry. Okay. So, what you want to make sure you're doing in this market is to work with an experienced agent. Number one, you've got to be working with someone who has actually been in the business for a while or is actually closing transactions. It's really difficult right now. And there's a lot of people that are getting out of the real estate industry and out of the mortgage industry. They're going back to whatever jobs that they had before this sort of housing crisis, I guess, that we're in, really, because we have just such a low inventory. Um, After you get an experienced agent, an experienced lender you want to work with, you want to figure out what is the best possible way I can buy a home for the least amount of money down. I put out content about the fact that you don't have to and really don't need to put down 20%. Now, there's exceptions to that. If you're in a situation where that's the only way you're going to be approved, if you put down more, great. But oftentimes, you're better off to hang on to your cash, pay off some debt, maybe do some improvements or repairs to the house, and maybe even just save some of the money just for your own emergency fund, rather than putting it all down. Keep this in mind: when you put down $10,000 on a property, an extra 10,000, it's typically going to reduce your payment on average about $60 a month based on today's rates. If you put down an extra $20,000, it's going to reduce your payment about $120. So the question then you have to ask yourself is, would I rather have $120 less payment, or would I rather have $20,000 remaining? There's people talk about PMI. I put out content about this. I talk about this. You can actually have the seller pay all of the PMI if you put 20% down. You can do what's called a single premium PMI, and you can have the seller pay, or you could pay it. But either way, PMI doesn't have to be forever. And the other thing, guys, what you need to know is PMI is so cheap these days. If you have good credit, I'm talking about conventional loans here with FHA. PMI is actually being reduced by 40% now, and that's huge. So whether you're on conventional or whether you're FHA, PMI is not a reason to think about, well, I just need to put 20% down. So there's first-time buyer home programs out there in every state, virtually every state, I think, except for Hawaii. So if you're in Hawaii and you don't have a first-time buyer program, that may be the case. But every other state, there are grant programs, there are bond programs. It just means that there's these programs that will actually grant you the down payment and or the closing costs for for the home purchase. And then remember, though, real estate is hyperlocal. So whether you're in Nashville, where I am, or whether you're in Denver or San Diego or San Francisco or Miami, it's going to be different. New Jersey, Texas, and even within those states. I mean, like right now, my friend Justin Colby, and I is down in Miami. I just got off another call with a friend that's down there, is looking to buy his first home in South Florida. And South Florida is just, there's no letting up. It's still tough down there, even with all the problems they're having with insurance. But the cost of living in some of these states where people are moving is still lower than a lot of the other states. And a lot of it is because no state income tax, lower cost of living, um, and the fact that you just don't have um, a lot of the things that you have going on in some of these other states that are keeping prices from going up. So let's move on to the next one. Get out of this. Sorry for the technical difficulties on the screen share. Um, the next thing I want to talk about is how to use a HELOC to buy your first rental. So if you're in, um, you know, question was that we had asked was how do I do that? How do I use a HELOC to buy a rental property? Well, you already have a property, you're looking to purchase another one, and you have equity in your current home. You can get what's called a home equity line of credit or a HELOC. It's the same thing. And when you get a home equity line of credit, it's just a second lien that's against your house. It's usually a little bit higher rate. It's a floating rate. I wouldn't be so scared about that only because it's a smaller loan. But the idea with the home equity line of credit is you can open it up. You may or may not have to draw out all the money. You may just be able to leave it at a zero balance or right, and then you don't draw it up until you need it. But then when you're ready, you can deploy the funds for maybe a down payment on a rental property. Now, on a rental property, you're typically going to have at least 15% down. Most of the time, 20%. So the idea is you've got a home now, you've got 30% equity in it. You can get a HELOC for, up to 90%. All that's to say is that you can get a HELOC if you have equity in your house, enough equity, and you can use those funds to purchase the next one. When you deploy those funds, you want to make sure that you get a pro forma. A lot of any great agent that's out there is going to give you a pro forma to show you what the rental is going to look like and what your cash flow is going to look like, all the expenses with regards to it. So you don't need to be worrying about, you don't have to worry about, is this going to work? And sometimes it doesn't work. I mean, you may have to look at several to determine if this is going to be the right property or if it's going to be the one that's going to work. Is it going to be too expensive? I've looked at properties. We look at the pro forma. The numbers don't work. You have to pass. And some of that's because of rates. So we can talk about that a little bit. Like rates, what is likely to happen in rates? Well, finally, we had a breakthrough in inflation and the Fed is now talking about pausing on raising rates. And what they've been doing, just to recap, the Federal Reserve does not dictate mortgage rates. They dictate short-term rates, which are home equity lines of credit, credit cards, all that sort of things, consumer stuff. But what it does when they raise those rates, it stops inflation. Well, mortgage rates are dictated by really the trading of mortgage-backed securities. And when these rates, the mortgage rates follow inflation, if inflation goes up, mortgage rates go up. And that's where we are now. So the Fed has been hammering down short-term rates so that the long-term, so inflation will go down and therefore long-term rates will follow. Long-term rates obviously being mortgage rates. So if you are in a situation where you have an opportunity to buy a home, you want to look at what is the cost of waiting if I wait till next year or later in the year. So you want to look at what is the expected appreciation in the market that you're looking in over the next few months, if you're looking in 6 months, or the next year, if you're looking in the next year. And then you want to determine if it's better for you to wait or to purchase. But you need to understand that rates and prices of homes work in an inverse relationship. When rates go up, prices go down. You can literally look on a week to week basis. When mortgage rates went up a few weeks ago, we started to see a little bit more concessions from the seller, a little bit of price reductions on. And again, it's all hyper local, but I'm talking about the overarching, and this is the way it works. Now, if rates go down, prices will go up. And why is that? Well, when rates go down, that is a situation where more people are into the market. You've got more people jumping in. And when more people jump in, now you have more demand, and more demand is going to cause the seller to be more choosy and not lower prices. In fact, they may say, hey, I've got something good here, and I'm going to price my house a little bit higher. So do we have any other questions here? I hear a question here about what does this say here? why would there not be why would the recession not cause housing to go down? Well, the reason why that the recession is not likely to cause housing to go down is because recession is not tied to housing. The only recession that's been tied to housing is the '08, and that recession was actually caused by the housing bubble. Now, if you look back to any other recession, including now and skipping the one that we've had in '08, but going all the way back to 1941, every single recession, prices have gone up. And so, as crazy as it sounds, it's like, I get it, guys. Like, it's expensive out there. I mean, we've got kids that need to buy a home someday, right? And they're going to grow up. And I feel it. I feel the heaviness of those of you who are first time buyers and feel like that the American dream has passed you by. It is more expensive. But buying a home is one of the most important things you can do. I don't really care what Grant Cardone says. He, I don't agree with that. I know this for a fact is that you know people who own a home have 40 times more wealth than the average person who does not own a home. The average person who rents has a net worth of about $6,000. The average net worth of a homeowner is about $240,000. It's a massive difference. So the question you have to ask yourself is why? Why is that the case? Well, you get the appreciation. And like I said, housing has been a winner for 80 years. And you're talking 7 years it went down. And some of those years, you're talking about a 1% decline. So very, very small. But 73, 7, and 1 over the last 81 or 2 years. And that is a pretty good record when it comes to housing. Did it go up or did it go down or did it stay flat? So 1 year it stayed flat. But there was a time in 1941 where housing actually went up 40 years in a row. I mean, we're talking a massive uptick. And so every single year, I mean, we're talking about a compound of 118% increase in home values. And so the big thing about winning, it's going back to how to win in this market. A lot of you guys live in some really nice markets. I've got people that'll chime in and they're living in La Jolla, San Diego, or they're living, Miami, or they're living in just an expensive area, right? Austin, even, right? We're Texas. You guys have really expensive property taxes, but you need to know that these. I forgot where I was going with that. Anyway, prices are still going up. Oh, I know what I was going to say. So you have to realize that the closer you are into the middle of the city, the more expensive it's going to be. You're going to have to move further out and start smaller and work your way up. I know, and also, guess what? Sometimes it's okay to rent. Sometimes life circumstances, you need to stay close to a child. You need to stay close to, maybe you're divorced. You need to stay close to, your family, and you need to rent, and you can't afford to move an hour or 45 minutes outside the city. But just know, the further you move out, the more chance you're going to have. You can literally get a house for less than $1,000 down with an USDA loan. It's a rural development loan. It's a government loan, a government-backed loan. That's 100% financing, means it's zero down. The $1,000 really just covers the few ancillary fees that you have up front, which is like the appraisal, the home inspection, that sort of thing. And so you're going to have a couple of expenses like that on the front end. You're also going to have an earnest money deposit. Now they call it trust deposit. So, but there are people that are winning with these products. Closings happen, just like my friend Ricky Crude says, down in Gulf Shores. Closings happen every single day of the year. Every business day of the year, there are closings in every market. Now, are there fewer sometimes? Yes. There's a lot smaller pie. There's less closings happening this year, right, than there have been in the past. And that's going to happen. That's going to be the same for next year. And then when we get to 2025, we're going to see probably one of the biggest years, if not the biggest year in the history of home purchases. Now, I have listened to multiple analysts, multiple economists talk about this, and every single one of them talk about 2025 being the year where that is where everything is lining up, because rates coming down, when rates come down, more and more people are going to enter the market. You're going to have more people wanting to buy. And then, I think by that time, you're going to have some people that are sitting on their 2.5, 3.5% interest rate that really are sick of their home. They've outgrown their home. They've got to move, and they're going to start putting those homes on the market. Now, that's an anomaly we just have not seen. This idea of people sitting on this low rate because the current market, and they don't want to move because the current market rates are so much different from where they bought. We just haven't had that sort of phenomenon. And I'll go into that in other videos, but the reason for that was the Federal Reserve and Jay Powell decided to continue to lower rates to a level that it was just unhealthy, and it just caused rampant inflation, and it's caused the problem. The idea is we probably should have never gone down to that, and that's causing the problem now. We probably should have stopped at around 4.5, 5%. Instead, it just was, kind of a free for all, and you had people snatching up homes left and right, and now they're sitting on those homes because why sell? Well, that's another good thing, another good topic to think about. Maybe you don't need to sell. Maybe you keep your property and you buy the next one, turn your current property into a rental. So if you've got a property and you got 2 5/8% interest rate, which is 2.65 or something like that, some crazy rate, or 3.5, and you're just like, man, I've got this equity. Well, you can pull the equity out and either buy a rental property, or if you want to buy another primary, you can convert your current property into a rental property and then buy the next one. Now, we own rental properties, my wife and I think one of the biggest things that you probably worry about, and this was the same for us, is, am I going to get a call in the middle of the night and, we've got a sink stopped up or something like that? And I just wanted you to know that when you have a property manager, that never happens. So I've never once been called about something that's needs to be fixed. You have people on staff. You have people that the management company is going to take care of that. The pro forma that we talked about is going to take care of the expenses that you're supposed to expect when it comes to maintenance expenses. Somebody asked, why is there so many more millennials turning age 33 than in the past? Well, it's a great question. In 1973, you actually had this massive dip in birth rates. And what happened? What was significant? Those of you who are old like me, who were actually living in 1973. But what happened I was only 5 years old, but what happened in 1973 that would cause the birth rates to go low? Well, it was the Roe v. Wade. Abortion became legal. So then you had this huge dip in birth rates, and so household formations were lessened. So you had less household formations. What is a household formation? That's just where a kid grows up, maybe he moves out of the house, and he buys his own home. So now a new household has been formed, right? You had years where that was lower. Now we have one of the highest birth rates in history that happened in 1990. So now you've got people turning 33 at the highest level, the highest rate that we've ever seen, and that is really propping up the demand. So you have this massive amount of demand that's out there that's sitting on the sidelines, and a lot of people, they just don't know what to do. Like, what are rates going to do? Well, good news is this week, like I said earlier in the broadcast, is you have inflation finally breaking through and finally getting through to the Fed, that they're actually gaining some ground and stopping inflation. Now, are we going to get down to 2%? Personally, I have concerns about that. And I don't think it's realistic. But if they're hell bent on doing that, we're going to have issues. But what I do know is that the numbers show that we have a glut of demand and a lack of inventory. And that's just going to, when rates come down to 5.5%, what happens is America, generally speaking, behaviorally speaking, when it comes to entering into the mortgage market, they do so and they go in droves when rates go into the mid fives. So just buckle up when you see rates go to mid fives. Everybody's going to want to start selling, because now, okay, I can sell, and now I can buy another home, and now um, we can actually afford a home. So you have all these people that are waiting, and guess what? You think is going to happen to some of these institutional investors like BlackRock, Blackstone, who are buying homes uh, in big chunks. I mean, they're going to a neighborhood and buying 20 homes in a neighborhood, and their really sweet spot is that starter home, that 250,000, 200,000, 250, 300, 350,000. That price point is so difficult right now to purchase a home. Why is that? It's because the amount of demand and the competition for that price point is so high. So in other words, you don't have that kind of demand for $1 million house, a $1.5 million house, a $3 million house, a $4 million house, right? $10 million house. You don't have that. But these institutional investors have realized that housing is an amazing investment. And so, these fund managers, there's, all they're doing is they're giving them some money to go spend to get the returns for the investors. And so if housing is they're buying housing, that has to tell you something. They realize that this is a good investment, and they should. But you can get burned in the housing market, right? It's not for everyone. You shouldn't overstretch yourself. You should never overextend yourself. Um, you should make sure you have some reserves left over. We talked about earlier that putting 20% down may or may not be the best thing for you. It's typically not. Now, listen, if you're selling a home, your $1 million home, and you're netting $400,000, maybe you want to put 20% down on the next house. I get that. But that's a little bit different story. I'm talking about really a first time buyer that's stacking cash and trying to get into their first home. Don't wait around and save up 20%, right? You're just going to be saving yourself out of the market. The market's going to continue to increase. We're going to see 5 to 6% appreciation this year. We're going to see a little more next year, and then even more in 2025. So one thing I didn't mention earlier is the lack of inventory was also caused after '08. You had builders that really stopped building a lot. So the amount of homes that were being built by builders was really stamped out. You had a lot of millennials that said, "Hey, I'm not getting into the market after that. What I just saw, that was a bloodbath. I think I'll pass." Well, now fast forward, and now there's a problem because here we are 10, 15 years later, and the builders can't keep up. I don't know if you've looked at builder stocks lately or look at what builders are doing, but builders are on fire and they can't keep up. New construction is where it's at right now. So um, if you can get out there and find a new construction home, the builder may or may not, depending on the market, be willing to offer you a seller concession right now, meaning offer to pay closing costs. Right? We've already seen homes reach the bottom in most markets, and some homes never started going down in some markets. But you're going to see the biggest swings in the places that you had the biggest increase, the biggest upswing. Seattle, my boy Darius up there. Uh, he's a realtor, a great realtor up there, big producing young guy, immigrant with amazing story. That's just so just heart filling that he just came over this country and is absolutely freaking crushing it in the real estate business. He's been here since he was 12 years old. But you look at Seattle, you look at the Bay Area, SoCal, Miami, these are places, New York City, again, that's an entity unto its own. That's New York has got so much foreign money coming in. It's almost hard to comment about New York, but a lot of these other areas, they just even haven't had prices go down. So now, when rates are starting to come down, we've already seen the bottom for a lot of these markets. So all of the crash bros, like, where are you? I mean, I had guys ripping my ass saying we're going to see a 60% decline. You ding dong. And that's the PG version. I can't tell you how many people commented on my TikTok, on, Facebook, Instagram back, several months ago when we were predicting what's going telling you guys, here's what we see. We're not going to see a crash. Oh, there's going to be a crash. We're going to have a massive crash. And, I don't have a crystal ball, but again, we can look at the data. And barring some sort of massive world war, we're not going to have a crash. Supply and demand. We have 600,000 homes available for millions upon millions of people that are wanting to buy homes. That's a problem. And but there's ways to win. Again, you want to make sure you're working with somebody that's a great agent. You want to look at all alternatives. So 0 down, 3.5% down, FHA. You can get a 3% down loan with conventional. There's a 1% down loan that's available out there. You can actually get 0 down with USDA, rural development. There's rural development does not necessarily mean, rural development, again, USDA, does not mean you're living out on some farm necessarily. There's whole neighborhoods that are designated USDA eligible. It just means that they're out in the county. So it's a really great opportunity for someone to be able to get into a home. You could even buy a manufactured home. And, you know, manufactured home can be a great first time investment. You know, the property values do go up. You know, the property, the house itself, it's not going to hold. It's not going to stand up for as long as a stick built home. A manufactured home is not. But it's still over 20, 30 years, you're still going to have a massive appreciation typically over time. It's not going to be as much as maybe a stick built home. But again, part of that depends on location. So thanks for tuning in. I'm going to see if there's any other questions here. We've answered a few, got a few more that we can answer. But this is all the time I had. Guys, thanks for tuning in. And we'll do this again next week. And I'll see you soon.